Before we begin, if you value understanding the systems that quietly shape your life, take a moment to subscribe. We explore these stories every week, calmly, clearly, without noise. Imagine waking up to the headline, "The United States just crossed $36 trillion in national debt." Now imagine something even more alarming, the annual interest payments on that debt quietly surpassing the entire U.S. defense budget. Let that sink in for a moment. The country with the largest military on Earth now spends more money servicing debt than protecting itself. It's a paradox that sounds impossible until you look at the numbers. In 2025, U.S. interest payments are approaching $1.2 trillion a year, nearly 4% of GDP. A fiscal cliff hidden behind spreadsheets, political noise, and a belief system that the dollar can absorb anything. But here's the part no one wants to say out loud. If the United States hits a debt crisis, it won't stop at America's borders. It will hit Europe first, and hardest. To understand why, we need to rewind. Back to the moment the dollar became something more than just a currency. Back to when the world unknowingly agreed to let the United States borrow almost without consequence. After World War II, the dollar became the backbone of global trade, not because it was flawless, but because it was the only currency trusted enough to anchor a new financial order. This exorbitant privilege, as economists later called it, allowed the United States to take on debt at a scale no other nation could dream of. Countries bought U.S. debt not out of charity, but because they needed dollars to trade, to store value, to settle contracts. And as global trade expanded, so did the demand for American debt instruments, especially U.S. Treasury bonds. This created a unique illusion, the idea that the United States can never truly run out of money. Because if demand for dollars keeps rising, then Washington can simply issue more debt, inflate away the old debt, and let the world keep absorbing the consequences. But illusions don't last forever, and in late 2025, cracks are becoming impossible to ignore. Global investors are quietly asking a dangerous question: what if the U.S. can't inflate its way out this time? Because inflation does something subtle. It doesn't just reduce debt, it erodes trust. And trust is the true foundation of the dollar system. Today, that trust is weakening. Slowly, quietly, but unmistakably. And when trust erodes at the core of the system, it doesn't collapse straight down. It collapses outward, toward the places most exposed. Which is why this story is not really about America. It's about Europe. To see the real danger, we need to look at how the global financial system is stitched together. Because the United States isn't just another economy, it is the central gear in a machine of interconnected balances. Let's start with a simple number that barely makes the news. European banks collectively hold trillions of dollars in U.S. Treasury bonds. These bonds are considered risk-free, the safest collateral in the world, the foundation for thousands of financial contracts and liquidity operations. But what happens when the risk-free asset begins to wobble? Every major European bank, from Frankfurt to Paris, from Amsterdam to Milan, uses U.S. treasuries as the backbone of its balance sheet. If treasury values fall sharply, even for a short period, banks suddenly face capital shortfalls. They need to raise cash. They need to sell assets. They start tightening credit. And that's how a crisis spreads outward. Fast. This isn't a theory. It has already been tested. In the 25 EBA stress tests, even under extreme scenarios, the assumption still underestimated just how violently a U.S. debt shock would ripple through Europe. Why? Because most models assume the United States will always do what it has done for decades: raise the debt ceiling at the last minute, reassure the markets, and keep the machine running. But what if the machine hesitates? Here is the uncomfortable truth. The danger isn't a U.S. default itself. It's the credibility erosion leading up to it. If investors begin questioning whether Washington can keep rolling over its debt without political paralysis, then Treasury yields spike, the dollar weakens, and global liquidity dries up. And when the dollar weakens, Europe feels it first. Why? Because Europe imports energy, raw materials, and critical industrial inputs priced in dollars. When the dollar becomes volatile, Europe's import costs swing violently. Its trade balance contracts. Its inflation becomes harder to control. A U.S. debt scare is not just an American problem. It's a European survival problem. But the real trigger, the spark that could ignite this crisis, is not financial at all. It is political. In Washington, the battle over federal spending has turned into a kind of fiscal theater. The fiscal hawks demand dramatic cuts. The other side refuses to touch entitlement programs, and somewhere in the middle, the rest of the world watches nervously as America argues with itself over whether to pay its own bills. Markets don't fear debt. They fear indecision. They fear uncertainty. They fear a government that might weaponize the debt ceiling as a bargaining chip. And right now, that fear is spreading. Layer on top of this another destabilizer, the renewed trade wars of the mid-2020s. New tariffs, retaliation, disrupted supply chains, slower global growth. All of it pushes the U.S. further into borrowing, while simultaneously weakening the very global trade flows that make the dollar dominant. This is the illusion that is finally cracking. The idea that the United States can borrow endlessly because the world will always need its currency. What happens when the world begins to doubt that? When the trust mechanism, not the math, breaks first. Because once trust begins to slip, the fall is rarely slow. So what does all of this actually mean for Europe, for global markets, and for the ordinary person trying to save, invest, or simply plan a future? The first impact arrives inside the banking system. When U.S. Treasury values swing, European banks must shore up capital. That means less lending, tighter conditions, and slower economic activity. Small businesses feel it first: higher borrowing costs, reduced credit lines, delayed investment. Then it spreads to households. Mortgages become more expensive. Car loans tighten. Savings accounts fail to keep up with inflation. The cost of living rises, not because of local decisions, but because of a political standoff thousands of miles away. The second impact hits Europe's trade engine. A weakening or volatile dollar disrupts energy imports, oil, gas, raw materials, industrial metals. Suddenly, companies that rely on dollar-priced commodities face unpredictable input costs. Margins shrink, prices rise, competitiveness erodes. And in a region already fighting inflation, this is the last thing policymakers want. The third impact is more psychological, but just as powerful. When the world's safest asset becomes a source of anxiety, investors look for alternatives. Capital moves unpredictably. Safe haven flows intensify. Volatility becomes the new normal, and once volatility takes hold, it rarely leaves quietly. But here's the part that matters most. A U.S. debt crisis does not start with default. It starts with doubt, a creeping sense that the system is not as stable as it once appeared. We are entering a period where doubt itself is the risk, and trust, not interest rates, becomes the most valuable currency. So what can ordinary people do? How do you protect yourself in a world where even the dollar can shake? History offers a few clues. Gold has served as a shock absorber during every major debt crisis. It doesn't generate yield, but it preserves confidence when everything else feels uncertain. Diversification across currencies and geographic regions helps reduce exposure to any single system. Not to speculate, but to create balance. And then there's something new, a lesson from the last 5 years. Even during crises, certain sectors continue to grow. Artificial intelligence, energy transition technologies, and high-efficiency infrastructure. These sectors don't rise because the world is stable. They rise because the world is transforming. The real takeaway is simple. A U.S. debt shock would not destroy Europe, but it would expose how deeply Europe depends on a system it does not control. And when the backbone of global finance starts to tremble, the smartest strategy is not fear, but awareness. If this gave you clarity, stay close. We explore these hidden mechanics every week, calmly, clearly, and without noise. Welcome to Financial Room,